of corporate training for about 12 years, including working with the company ArcelorMittal, which is world's largest steel and mining company. I was with them for considerably long period, and during those 6 years that I was with them, and I'm sure all of us know that ArcelorMittal is world's largest steel and mining company. So I delivered my training programs all over the globe in more than 50 locations. Uh, then one day again, after working there for 6 years, a thought crossed my mind: how much to travel, and travel the whole world 4 times. So then I thought, why not to do something new now? And that is how, in the year 2017, I started practicing as a chartered accountant. So when I started practicing as a chartered accountant, this insolvency course came, which I qualified and became insolvency professional. Then the evaluation course came. Then I qualified valuation exam also and registered with IBBI. Thereafter, independent directors course came. That also I completed. Now I'm also on the board of a NSE BSE listed company as independent director, company called Surat Bala Business Group Limited, and I'm also on the I'm there as a chairman of the audit committee of this company. Uh, Now this topic, taxing matters, the crucial role of valuers in income tax assessment, apparently is quite interesting. And why it is interesting? Because for we professionals, uh, handling all these matters which are so perplexing, and they are perplexing not for anything else, that is primarily because of the diversion of the interest that we have. So, as the evaluation professional, for us, the interest of the clients is of uppermost importance, and for the department, saving the revenue for the exchequer is of the paramount importance. And that is how there's a tussle constantly going, and that sometimes become very perplexing. And what adds further salt to the wounds is there are too many and too frequent changes in the legislation, which again creates more complexity. So, this topic of taxing matters, the crucial role of valuers in income tax assessment, uh, when I thought, when I got a call from the RVO for taking this session, I thought, how can I add value through this session? Then I came across three judgments. One was of Bhoruka Engineering Industries Limited versus DCIT, and in case of this judgment, revenue contended that transaction of sale of shares was a colorable device and virtually immovable property had been transferred. While rejecting such argument, the High Court observed as the assessee by resorting to such a tax planning has taken advantage of the benefit of the law or the loopholes in the law, which had ensured to his benefit. After seeing how this loophole has been exploited within four corners of the law, it is open to the parliament to amend the law plugging the loophole. Then another case law that I came across was DCIT versus Maya Appliances Private Limited. In this case, according to revenue, the SSC sold the actual land and building in the guise of sale of shares, and thus the provisions of the Section 50C is applicable. However, the tribunal declined to adopt this argument and held that no question of invoking the provisions of the Section 50C of the Act, as there is no direct transfer of land or building or both. And then there is a case of Med Plus Health Services Private Limited versus ITO. So all these case laws and many of them center around many of the cases. And one area which is always of contention as far as the valuations are concerned, and that is valuation of unquoted equity shares. We all are aware number of cases where by virtue of transfer of the shares, the entire company together with the land, building and everything has been transferred. And therefore, to some extent, it cannot be denied that there has been cases where the provision has been misused, or as the court said, is used for the purpose of tax planning. And that matter pertains to the valuation of unquoted equity shares, and that is Rule 11 UA 1CB. I'm sure all of us are aware that there are many complications, many confusion as far as valuation of unquoted equity shares are concerned. And therefore, I thought, why not to take up this topic, which is taxing not only for the department but also for the V valuation professional, and demystify it to the extent possible. And this is what I have attempted in today's session with all of you, demystifying the computation of fair market value of unquoted shares with the help of a case study. Now, before we start the case study, we all are aware this 11 UA 1CB. So there's a formula which is prescribed, which is also referred as the NAV. But if you really ask me, this formula which is referred as NAV, it is really speaking is not net asset value. In my view, it is partially partially not only NAV, but it is also adjusted value method. So we will see as we move forward that it is, when you say NAV would mean that you simply pick up the balance sheet, and whatever the numbers are given in the balance sheets of the assets and the liabilities, net them off, and whatever the net amount is coming, that is the value of that particular company, that is NAV. But in this case, in this rule 11 UA 1CB, the methodology which has been prescribed, it is combination of book values and also adjusted book values, and that is why I call it as partially adjusted book value method. So what this formula prescribes, it has got A, and that A stands for all the assets in the balance sheet of a company other than B, C, D. And what is B? B is your jewelry. C is your other work of art and things like that. And D is for your land and building. And L is for the liabilities. Now again, in case of liabilities also, friends, it is not that you pick up all the liabilities as they are given in the balance sheet. Some of the liabilities you pick up as it is when you are computing the fair market value for the unquoted equity shares using the Rule 11 UA 1CB. So some of the liabilities are picked up as it is, and some of the liabilities are to be adjusted, which is as per the formula prescribed. Now it is based on balance sheet, hence really speaking external report is not required. Generally speaking, if it was to be simply net asset value method, then there was no need for any external report required. But apparently, as we will notice, that there are situations prescribed where a report of a valuer is required. And that is what we will have to take care of it actually. So whenever the report of a valuer is required, whether for the purpose of land and building, or for the purpose of gold and jewelry, or for the purpose of work of art, in all the cases it is recommended, whenever a report is taken of a valuer, please remember it is not the valuer who is registered with the IBBI, but it is the valuer who is registered under section 34 AB of the Wealth Tax Act 1957. Of course, the Wealth Tax Act is revoked, but there are a few provisions, a few sections which are still applicable. So whenever you are doing valuation for unquoted equity shares as per Rule 11 UA 1CB, you will require certain reports, and those reports will need to be obtained in my view, from the registered valuers who are registered for the purpose of income tax matters. Now, let us go step by step. And this question, which I would like to put before all of you, because we are in a virtual mode, and in a virtual mode, the difficulty is the interaction is not possible. Still, I can always share some questions with you for your contemplation. So, what is the philosophy and objective of the department behind Rule 11UA1CB for determination of fair market value of unquoted equity shares? So उनकी philosophy क्या है और उनका objective क्या है behind the Rule 11UA1CB? Now when I think about it, what comes to my mind is the the philosophy and the objective of the department is the assets should not be understated. So when you are doing the valuation of unquoted equity shares, what is the thought process of the department is assets should not be understated and the liabilities should not be overstated. Thereby, the fair market value should be maximum so that there is a maximum capital gain and therefore there is a maximum tax. Now this is the thought process and the philosophy and the objective behind the methodology which has been specified in 11UA1CB. Now, if we keep this philosophy or this objective of the department in our mind, in my understanding, the understanding of this methodology will become very easy to apply for all of us. So this is what we need to understand as to what is driving the government or what is driving the department in coming out with this particular methodology is to ensure that the assets are not understated, liabilities are not overstated, thereby there is a maximum capital gain and thereby there is a maximum revenue. So this is the thought process behind Rule 11UA1CB. So how does it work? What the rule is, and let's look at one by one. So this is the formula which I am sure all of you would have come across many times. The A plus B plus C plus D minus L. PV is the number of shares that are to be valued, and PE is the total number of shares which are the outstanding shares of that company, which is basically to find out the pro rata value of the number of shares which are proposed to be transferred. Now, so what you have in this, what A stands for? A stands for book value of all the assets which are given in the balance sheet other than jewelry, artistic work, shares, securities and immovable properties. So ये जो 5 जो आइटम जो मैंने आपको बताया अभी बोले आपके सामने, ज्वेलरी, आर्टिस्टिक वर्क, शेयर्स, सिक्योरिटीज एंड इमूवेबल प्रॉपर्टी, ये 5 आइटम को छोड़ के बाकी जो सारे आइटम्स हैं बैलेंस शीट में, those can be picked up as it is for the purpose of computation of fair market value of the unquoted share. Now there is a rider here, and what is the rider? The rider is in the balance sheet as reduced by. So you take all the numbers which are given in the balance sheet of all the items other than the jewelry, artistic work, shares, securities and the immovable property. वो सारा ले लो आप. Now what you have to do? You have to make some adjustment. What adjustment you have to make? The adjustment that you have to make is any amount of income tax paid. So the company for which you are doing the evaluation of the company of which you are doing the evaluation, the company must have in the balance sheet, or the company must have paid TDS or TCS or advance tax. So whatever advance tax or TCS or TDS the company has paid, now that amount is to be reduced by the amount of tax refund claimed, right? The amount of tax refund claimed. So that is one adjustment that is to be made, and we will understand with the help of a case study as we move forward. This is one adjustment. So whatever the advances that you have paid, advance tax or the taxes that you have paid, minus the amount of income tax refund that you must have claimed, whatever is the difference, that difference has to be deducted from the total of all the assets in the balance sheet other than these 5 items that we have just now spoken about. Okay, so that's adjustment number 1 that you do. Adjustment number two, do you do it for the unamortized amount of deferred revenue expenditure or deferred expenditure. Now, what is this supposed to be and why it is supposed to be deducted? Now, remember, friends, first of all, what is deferred revenue expenditure or deferred revenue capital expenditure? So sometimes what happens, companies do spend a sizable amount on the ad campaign or things like that. The benefits of these expenditure do not accrue in 1 year, but they accrue over the years actually, and therefore the accounting of these revenue expenditure would be done is the entire amount which has been spent on the ad campaign. Let's say for example, that will sit in the balance sheet as an asset. Though remember, it is a fictitious asset. It is absolutely it's an asset which is only on paper. That asset has got no value, so you cannot sell it tomorrow to somebody. So but that will be recorded in the balance sheet on the asset side as deferred revenue expenditure. Now how do you write it off? So you write it off this amount over the life of that ad campaign that you must have carried. So say for example, the ad campaign that you carried out was going to give you benefit for next 3, 4, 5 years. Let's say 5 years. So you will write off this amount of the deferred revenue expenditure over 5 years in equal installments. So whatever is the unwritten amount of deferred revenue expenditure which is appearing in the balance sheet, according to 11 UA 1CB, that amount is to be ignored. That means what? That means you take all the assets into account other than the 5 assets that we just spoke about, but in all those other assets do not include the deferred revenue expenditure, unwritten amount of deferred revenue expenditure. And why is that so? Because this is not an asset. It is only a number which is appearing in the balance sheet. It has got no real value. It is a fictitious asset which is there in the balance sheet only for the purpose of accounting. And as I said, what the department wants, department does not want that the assets must be overstated. Department does not want that the liabilities are overstated and the assets are understated. Department does not want. So when you remove the deferred revenue expenditure, obviously what you are doing is you are bringing the assets. Removing the assets which are not really of a value, and that is what you are doing. Now, before I take the remaining portion, let me ask you this question. Will A in the above formula also include tangible assets? So, ये जो formula है, this formula that we are talking about, and the A that we are talking about of all the book value of all the assets, whether intangible asset will be part of the book value of all the assets, and the answer is yes. Please remember, the answer is yes. Intangible assets like technical know-how fees, good your brand name, copyright, logo, market customers list. Now all those software, all those intangible assets, design, patent, all those intangible assets, remember, will definitely form part of book value of all the assets. Those has to come. And what is not to come is this unamortized amount of deferred revenue expenditure. And why is that? Because this has got no value. Remember, patent has a value, technical know-how has a value, technology has a value, customers list has a value, software has a value. Those can be sold. But this unamortized amount of deferred revenue expenditure, this cannot be sold. So remember, the answer to this question is, will the formula given here include intangible assets? And answer is yes, except the unamortized amount of deferred revenue expenditure. Now question number 2, will capital work in progress on account of tangible assets or intangible assets will also be considered for the purpose of working out fair market value and be part of this asset? And the answer of course is yes. Capital work in progress, remember, whether for the intangible assets or for tangible assets, may not really be operative. So it may not be operative, but it is a real asset which is there in the balance sheet of the company, which is also there in the company, and therefore that will definitely be included. Number 3, what should be the date of the balance sheet for the purpose of determination of fair market value? Now this is a very critical question, precious question. Now friends, in my view, there is a lot of confusion that every time when the valuation has to be done, the balance sheet has to be again audited, and an audited balance sheet has to be prepared, and the audited balance sheet has to be used. Now in my view, that may perhaps not be the right thinking. Why? Because if there is a company, okay, unlisted company hai, private limited company hai, unquoted shares hai, and there are many transaction happening of such transfer, do you mean that the company will have to do the audit every time and get the accounts audited every time? And remember, what is the sanctity of the accounts which are audited unless they are approved by the shareholders, unless they are approved by the board of directors? So all those formalities, if are to be done every now and then, it will become very difficult for the company to function. So therefore, in my view, last audited balance sheet should be a good enough basis for the purpose of doing the valuation of unquoted equity shares. At the most, what the buyer and the seller can do, the buyer and seller can prepare a document where they can mention that the buyer is interested to buy the shares of the company, seller is interested in selling the shares of the company, and both of them agree that for the purpose of valuation for this transaction, the balance sheet or the last audited balance sheet will be the basis for the purpose of determination. So once you have that written agreed document between two of us ready with you, and I'm sure that should sustain and hold water with the department, because you are not being unreasonable, you are being absolutely reasonable. You are not using a document which is not authenticated, which is very much authenticated. The only thing is the regular audit that happens in case of a company, it happens only once. The statutory audit happens only once, and based on that the audited balance sheet has been prepared, and therefore in my view the last audited balance sheet should be good enough. Now then, of course, as regards the jewelry and artistic work, the how do you do the valuation? So as I said, remember the objective of the department is to ensure that the fair market value is really fair market value. So jewelry and artistic work, whatever are there in case of a company, then those cannot be taken on the face value. Those will have to be valued. And how they can be valued? So there are three ways in which you can value. Number one, they can be valued based on what it would fetch if it is sold in the open market. So that is number one. So if those jewelry is to be sold in the open market, what amount would it fetch? So that will be the fair market value for the purpose of valuation of unquoted equity shares. In case number two is if the jewelry has been bought from a registered dealer, then the invoice from the registered dealer will also be the basis for the purpose of valuation of the jewelry. And number three, if it is both are not possible, then a report from a registered valuer. And remember, when I say registered valuer, that means valuer registered as per section 34AB. That report will be good enough for the purpose of jewelry and artistic work, and that is what will need to be done. And then as regards to the share and securities, so for the shares and securities, it will be based on the same methodology which we are talking about. So that means if the quoted shares are there, then the quoted price becomes the basis for the purpose of valuation of the of the shares of unquoted shares of a unlisted company. In case if that company is also holding unquoted shares of some other company, then the same process will have to be pursued for the valuation of that other company, and that amount will need to be incorporated for the purpose of calculating fair market value under Rule 11UA1CB. And then D is the value for as far as the immovable property is concerned. Immovable property is concerned. Now, immovable property, whether it's land or building, they also cannot be taken on the face value. So whatever is the amount given in the balance sheet of the company, that cannot be considered for the purpose of deciding the value. Instead of that, what will need to be done is the value that would be adopted or assessed or assessable by an authority of the government for the purpose of payment of stamp duty in respect of that immovable property. So obviously here, if the company whose unquoted shares are being valued also has land and building, in that case, the valuation that will be decided by the stamp authority, that will be considered for the purpose of determining valuation of unquoted equity shares. Now, having done A plus B plus C plus D, as we have discussed, now you will have to minus the book liabilities. And again here, please remember, as I said earlier, you are not allowed to deduct all the liabilities. Some of the liabilities you would be allowed to deduct as they stand in the balance sheet, and some of the liabilities will need to be excluded. Now, what will need to be excluded? Let us look at them. So first of all, the paid up share capital in respect of equity share will need to be excluded. And obviously it has to be excluded because you are trying to find the value of the company. So when you are trying to find the value of the company, obviously the paid up share capital has to be removed, because that is what you are trying to value. And the number two, the amount set apart for payment of dividend on preference shares and equity shares. So if in the balance sheet there is an amount appearing on account of dividend on preference share or on the equity shares, now unless and until the dividend has been declared and approved in the shareholders meeting, this dividend will not be allowed to be deducted from the total of the assets, that is A plus B plus C plus D. So if the dividend has been declared and approved by the shareholders, then it can be deducted from the total of the assets and not otherwise. And I'm sure you can understand, and that is because a dividend becomes a liability of a company only when it is approved by the shareholders. Only when it is approved by the AGM, then only it becomes due for payment and not otherwise. And therefore, until then, it is not a liability of the entity, and therefore, if it is not approved, it will not be allowed to be deducted from the amount of the total assets that we have just discussed. The number two is reserves and surplus will also not be deducted. And I'm sure, friends, you can understand why the reserves and surplus will not be deducted. Reserves and surplus will not be deducted. That is because reserves and surplus are what? They are nothing but the shareholders' money which the company earned and flowed back into the business again. So instead of giving the profit as the dividend to the shareholders, the company retains some of the profit into the business, and whatever profit is retained in the business, that sits in the balance sheet under the head reserves and surplus. And since it is sitting in the balance sheet as reserves and surplus, ultimately whose money is this? The name may be different. The name may be share reserves and surplus. But remember, ultimately it is money that belongs to the shareholders. So it is money that relates to the equity share capital of the company. And therefore, reserves and surplus will also not be deducted. Will be excluded. And we will understand when we look at that case that I'm going to discuss with you. Number four is any amount representing of provision for taxation other than amount of income tax paid, if any, less amount of tax claim as refund to the extent the excess over the tax payable. Now please remember, what does it mean? In simple words, it means if the liability of the company on account of tax is 50 rupees, and if the company has made a provision of 100 rupees, and I'm sure you can understand, if the 100 rupees is deducted from the amount of the assets, now what is going to happen? It is going to reduce the value of the company. Now since it is going to reduce the value of the company, that means what? That means the capital gain amount is going to be less. If the capital gain amount is going to be less, that means less revenue to the government. And that is the reason why the government, the department wants to ensure that you deduct only that provision which actually relates for the taxation. If you have made any excess provision, that will not be allowed to be deducted. That means you cannot dilute the assets because of the excess provision that you have made. And not only that, friends, it simply means other than this is number 5, any amount of provision made for meeting liabilities other than ascertained liabilities. So if you make provision on account of bad debt, if you make provision on account of guarantee, if you make provision on account of something else which is in excess of the required amount, and therefore you can imagine, if you are making excess provision and you are doing the valuation of those unquoted shares taking into account the excess provision, what is going to happen? Because of the excess provision, the value of the assets is going to reduce additionally. That means the value of the shares that you want to transfer or you want to purchase or sell is going to be lesser. That means there is going to be lesser amount of capital gain, and that is why this provision, that any excess provision that you have made or any provision that you have made for unascertained liabilities, that means there is no liability that you know of but you still have made a provision, so that also will not be allowed to be deducted. And finally, friends, number 6, any amount representing contingent liabilities. Obviously, contingent liabilities do not form part of the balance sheet. Since they do not form part of the balance sheet, in any case, they are not frozen liability. And since they are not frozen liability, and therefore, obviously, they will not be allowed to be deducted in any case. So, friends, this is the formula of A plus B plus C plus D minus L. And I am sure all of you are completely clear as regards to the philosophy and the objective of the department behind putting this formula, and also the reason as to why all these adjustments have been specified very clearly, and that is to ensure that there is a fair market value, meaning there is really a fair market value. There is no reduction in the amount of the assets for whatever reason, and there is no increase in the liability for whatever reason, and thereby there is no scope for unduly reducing the amount of capital gain, and that is what it is. And PB, of course, as I said, is nothing but paid up capital or the number of shares. You can look at it number of shares which needs to be transferred, and P is the total number of shares of the company. So whether you look at in terms of number of shares or you look at it in terms of paid up value, ultimately meaning is going to be the same. But these are the two things that also are there as part of the formula. And why they are as part of the formula? They are part of the formula just to ensure that you are able to find out, really speaking, the value of the quantum of the share that you plan to purchase or you plan to sell. Now here again, there are two posers that I thought I will share with you. Number one, is preference share capital a deductible liability? Meaning what? Meaning when you are trying to find out the fair market value, you will deduct all the liabilities. You will not deduct you will not deduct the reserves and surplus. You will not deduct the equity share capital. Now my question is, will you also not deduct preference share capital in case if the company has preference share capital in the balance sheet? And the answer is, of course, you will deduct the preference share capital from the value of the asset, and that is because as far as the equity shareholders are concerned, even if it is preference share capital, for them it is a liability. For them it is a liability. So preference share capital is not part of the equity shareholders fund or equity shareholders capital. And therefore, please remember, when you are doing the computation, the amount of preference share capital, in case if there is in the balance sheet of the company, the amount of preference share capital will need to be deducted from the total amount of the assets that you have worked out. And number two, is share premium a deductible liability? Now friends, if you look at all these deductions that we are talking about here, there is no mention of share premium here, and neither it is here as part 5 or part 6. So the question is, what do? Do you deduct the share premium from the total of the assets, or you don't? And the answer again is yes. Even if the share premium is not reflecting anywhere in this formula, still remember, when you are computing the value of unquoted shares using 11UA1CB, you will have to deduct the share premium. And why you will have to deduct the share premium? And that is because, what is share premium? Share premium again is nothing but part of the shareholders capital. So when I say shareholders capital, that means it is part of the equity shareholders capital. So like reserves and surplus, it belongs to the shareholders. Share premium also belongs to the shareholder. So the share premium is at the same level as the reserves and surpluses. The only difference is share premium directly comes from the pocket of the shareholders, and reserves and surplus is what company earns from the operations and plows back. That is the only difference. Otherwise, there is no difference. So share premium also belongs to the equity shareholders, and therefore share premium will not be deducted. Like equity share capital will not be deducted. Reserves and surplus will not be deducted. Likewise, the amount of share premium will also not be deducted as far as this methodology as prescribed under Rule 11 UA1CB is concerned. Now let's look at the case study, and I'm just going to just brief you about the case study, and then of course we will solve it together. Right, friends. So this is the case study. On the following slide, balance sheet of XYZ is given as of 31st March 23. There are certain additional informations also given about the company's assets and liabilities as of 31st March 23. Now, based on this information, which I am going to share with you, Mr. X, who is holding 10% of equity of the company, wants to know value of his holding as per Rule 11 UA1CB under the Income Tax Act. As mentioned, obviously, since it is an unlisted company, obviously the valuation has to be done as unquoted shares. Unquoted shares. Now this is the balance sheet. What I am going to do, friends, I am going to draw your attention to some of the critical items of this balance sheet, which are relevant for us for the purpose of computation of the fair market value. So number one is preference share capital. Please make a mental note of it. Number two is share premium. Please make a mental note of it. And provision for dividend on equity and preference share. Also, please make a mental note of it. And rest of the things are absolutely fine. Now, on the asset side, please make a note of land and also make a mental note of building. And then, of course, plant and machinery is fine. CWIP, I am sure you would remember, I have discussed with you, office equipment, furniture and fixture, intangible assets, intangible assets under development, and inventory is okay, receivables okay, loans and advances also okay. Make a note of income tax paid by way of TDS, TCS or advance tax. Now typically whenever you make a balance sheet, income tax paid will always be part of the loans and advances as far as the reporting is concerned. But just to highlight it to all of you, I have shown it separately so that we are able to relate this transaction. Now, cash and bank is okay, other current assets also okay. Make a note of jewelry, artistic work, investment in shares, investment in other securities, and unamortized deferred capital expenditure. So make a mental note of all these items. Okay, then there are a few additional information, and what those additional information are. Number one, the company paid rupees 100 on account of TDS, TCS and advance tax, and the company has claimed refund of rupees 50 against the same. Number two, items of jewelry and artistic work which are given in the balance sheet, as we have seen, would fetch 25% higher value than their respective book value. So this is what is mentioned, and a valuation report for this purpose has been obtained from a registered valuer and it is available. Number three, investment in shares held in another company is worth 30% higher than the book value, and that value has been determined in accordance with Rule 11 UA1CB. A valuation report for this purpose also has been obtained from a registered valuer. Number four, investment in other securities held by the company. So remember, other securities mean what? Means what? Other securities would mean other than the equity shares. is worth 50% higher than the book value as determined in accordance with Rule 11 UA1CC. So for the unquoted shares, we do the valuation using Rule 11 UA1CB, and for doing the valuation of securities other than equity shares, we do the valuation using Rule 11 UA1CC, and this is other securities, and that's why the valuation has been done using Rule 11 UA1CC, and as per that report, the value is higher than 15% higher than the book value. Number 5, value of the land and building as assessed by the stamp authorities for the purpose of stamp duty is rupees 300 and 500 as opposed to the book value of rupees 100 and 300 given in the balance sheet. So you have this figure that you have obtained from the concerned authority. Number 6, the amount of dividend on the preference shares and equity shares have been declared and approved before the date of the proposed transfer at the general body meeting of the company. So that means it is a frozen liability and it is deductible. It is a frozen liability, hence it is deductible. If it was not to have been approved by the shareholders, then this dividend on preference shares and equity shares would not be allowed to be deducted for the purpose of this fair market valuation. But since it is clearly given in the case that it is approved by the shareholders in the annual general meeting, and therefore it will be allowed to be deducted. Please note the point number 7. The figure of short-term provisions in the balance sheet includes rupees 80 on account of provision for taxation, whereas the computed tax liability of the company is only rupees 50. So here you have a case where the provision that has been made is in excess of the requirement as per the law, and therefore this difference of 30, remember, will not be allowed to be deducted. The company was required to have made a provision of rupees 300 on account of bad debts. However, in actual it has made a provision of rupees 500, which is included in the figure of short-term provisions. So, ये company ने क्या किया? As per the past trends of the company should have and would have made a provision of rupees 300 on account of bad debts. But what the company has done, it has made a provision of rupees 500, which is in excess of the required amount of the provision. And therefore, please remember, and I'm sure it would be very clear to you by now, that this additional provision of 200 for bad debts will not be allowed to be deducted for the purpose of valuation of unquoted equity shares as per Rule 11 UA21 CB. And finally, the point number 9 is there are no arrears on account of dividend on cumulative preference shares capital. However, the company had contingent liabilities of rupees 300. Right. So there is no arrears as far as the dividend preference share dividend is concerned, but there is a contingent liability of rupees 300. So friends, I'm sure you would notice that this case has virtually captured everything of the items prescribed in Rule 11 UA1 CB. Now friends, what we will do, having this understanding about this case, let us try and solve this case and find out the fair market value for Mr. X. Right, so this is how we start. Book value of all assets other than jewelry, artistic work, shares, securities and immovable property, that is item number A. So what I have taken, and I'm sure you would have mentally noticed it, I have taken plant and machinery, I have taken capital work in progress, office equipment, furniture and fixture, intangible assets and also intangible assets under development. And these are my non-current assets and which are there in the balance sheet, and I have simply picked it up from the balance sheet because that is what I am allowed as far as the Rule 11 UA1CV is concerned. So these assets, there is no dispute, there is no ambiguity. Whatever is the amount in the balance sheet, you pick up those figures and straight away take into your calculations. Then there are current assets. About the current assets, I have taken inventories because there is no issue. Receivables I have taken, loans and advances I have taken, and cash and bank balance I have taken. Other current assets also I have taken, and there are no issues pertaining to these 5 current assets permitted. So the rule permits you to take these assets as per the balance sheet figure. So there is no adjustment required. Simply take them as it is. Now there is an issue with regard to the income tax paid, and that is why I have highlighted it. And there is an issue about the unamortized deferred revenue expenditure, and that is why I have highlighted it. So friends, as you would remember, what we have done, we have taken all the assets other than B, C, and D. We have taken all the assets other than from the balance sheet other than B, C, and D, that is gold and artwork and your land and building, immovable property. So the total comes to 6,650, and I am sure you will remember that it also when you look at the item A, it says all the assets in the balance sheet other than gold and art of work and immovable property. So we have taken all the assets, and the total comes to 6650. And the rule further says that this total will be reduced by the amount of advance tax the company would have paid minus the amount of the tax refund that the company may have claimed. So let us see how do we treat this. So amount of income tax paid, if any, less amount of income tax refund claimed. So what is the amount of income tax paid, as you have seen in the balance sheet, and it is also given here. So this amount is 100, and what is the amount of refund that the company has claimed? It is 50. So 100 minus 50, this 50 will not be allowed to be added, right? So this will need to be deducted from the value of the assets. So that's your number one. Number two, it spoke about unamortized deferred capital expenditure will also not be deductible. And remember why it will not be deductible. It will not be deductible because really speaking, it is not a real asset. It is not a tangible asset. It is not an asset that will fetch any value, and therefore it is an asset which is only on paper. And since it is only on paper, for computing the fair market value for the purpose of 11UA1CB, this amount also will be ignored. And that is how you will see 6,650 is the total of all the assets. And what we have done, we have reduced this 200, and therefore the total book value of all eligible assets under the group A comes to 6,450. 6,450. So that is one part of this case study. Let us go to the next one. And next one pertains to B, C, and D. Now, I'm sure you would remember as we discussed about the case. The case says that the amount of jewelry and the amount of artistic work will be higher by 25% than what is given in the balance sheet. So therefore, accordingly, this figure which was 100 is increased by 25%, and that is how it is becoming 25%. And the case also says that there is a valuation report also obtained for this purpose. Then artistic work, again the case says that the artistic work will fetch 25% more than the book value. For that purpose, there is a valuation report also available, and therefore 200, which is the original amount of the artistic work as given in the balance sheet, increased by 25%. So this becomes 250, and therefore 125 plus 250, we have taken 375 as the value of jewelry and the artistic work. And this is the value 6,450 that we have carried from the previous page, that is here. Right. Then you have the case says that the company is also holding unquoted share of another company, and it is also said that the actual value is going to be higher than what is given in the books, and accordingly the actual value for which the valuation report also has been obtained comes to 1690, and that is taken here. And likewise, fair market value of other securities. Now this is to be read as C and not B. So fair market value of other securities as determined in the manner provided in this rule, that is 11 UA 1 CC. Again, the actual value of those investment is going to be higher, and just to show it to you, is here in this figure, and so investment in share is 1300, and investment in other securities is 700, and the case says that that the investment value will be higher by 15%, unquoted share will be higher by 30%, and other securities will be higher by 15%. Accordingly, this figure which is given here in the balance sheet is increased to 1690, that is increased by 30%, book value increased by 30%, and here the book value increased by 15%. So total of these two comes to 2495. So that your B is done, your C is also done. Now coming to D, value assessed by the stamp duty of the government, authority of the government for the purpose of payment of stamp duty in respect of immovable property. So it is given in the case what the value of land is 100, value of building is 200, but as per the stamp authority, this value should be 300 and 500. Accordingly, it is taken as 300 and it is taken as 500. This value comes to 800. So 6450 is the value of all the assets other than B, C and D, and the value of B is 375, value of C is 2495, value of D is 800, and therefore the total of all the assets put together A, B, C and D comes to 10,120. Now from this 1,1020 we need to deduct the liabilities which are deductible, and let's see as to which are the liabilities which are deductible. So I have just carried forward this number of 10,120 for your reference. Amount of liabilities to be deducted from total assets computed above. Yani ki, what are the liabilities that need to be deducted? So what we have done, we have taken simply the total of entire liability. So the total of the liability side, that is 9,200. That is, so total liabilities as per the balance sheet is 9,300. Now liabilities not permitted to deducted. So we find out the liabilities which are not permitted to be deducted. That means the balance is permitted to be deducted. So what are not permitted to be deducted? Number one, paid up capital in respect of equity share. Number two, a share premium. Number three, reserves and surplus. So we have picked up these figures straight from the balance sheet of the company. Remember, preference share capital is not coming here. And why preference share capital is not coming here? And that is because it is deductible. Point number 4 of the rule says, any amount representing provision for taxation other than amount of income tax paid, if any, less the amount of income tax claimed as refund, if any, to the extent of the excess over the tax payable. So amount of tax provision made 800, amount of provision for taxation required 50, and therefore excess provision not permissible as a liability is 30. So this 30 will also not be deducted. Now point number 5 says, any amount representing provisions made for meeting liabilities other than ascertained liabilities. That means liabilities which are not ascertained, or liabilities which are ascertained but the amount of provision which is made is in excess of the required amount, that also will not be allowed. So in respect of bad debts, amount of provision made required is 500. Amount of provision required is 500, and amount of provision actually required. Amount of provision required for this is not required. Amount of provision for bad debts. Amount of provision for bad debts made is 500. Amount of provision actually required is 300. So 500 minus 300, this 200 is not going to be permissible. It will not be allowed to be deducted. Amount representing contingent liabilities other than arrears of dividend payable in respect of cumulative preference shares. And I am sure friends you would remember, as far as the dividend of preference share capital is concerned, there is nothing in arrear, and there are contingent liabilities. But remember, contingent liabilities are not allowed to be deducted when you are doing the computation of fair market value as per rule 11U1 CB, and therefore there will not be any contingent liabilities. So when you total all these components together, you get a figure of 5670. So 1400, 2000, and all this put together, I hope I have done the correct calculations. So this figure comes to 5670. Assuming this total is coming 5060, what you get is, so 11,120, sorry, 10,120, which is the total of the assets, and total of net liabilities permitted to be deducted from the total is, so this is the amount, remember, this is the amount which is not permitted to be deducted. That means what? That means 1,400, 3,400, so 3,400 plus 30, 230, so 230. So that means what is not permissible to be deducted is 3630. So 9300, this is what is not permitted. So 3630, what you get is 5670. So 5670 is what is permitted. So 10,120 minus 5670, what you get in the hand is 454450, and that is your fair market value of unquoted share of this company. 10% of this is proposed to be transferred, and therefore the value of the shares of Mr. X, which are proposed to be transferred and valued as per Rule 11 UA1CB, comes to 445 crore. So friends, this is the case which I thought I would share with you. I know I have been quite fast, but then we had only 1 hour available, and I somehow had to adjust the time. Okay, so before I close the session, just to tell you that I have a YouTube channel on which there are 1800 videos pertaining to finance, accounts, companies act, strategic management, NDS, insolvency, business valuation, India's economy, independent director, corporate governance, leadership, and work-life balance. So on all these 1800 videos, if you wish to take advantage of these, please do subscribe to my channel, and also let others know, particularly those who are pursuing any of the finance courses like CA, CS, CMA, ICW, CMA, or ACCA, CPA, and things like that. And you can connect with me on my YouTube channel and also on LinkedIn. I also authored these 2 books, You Are a Born Winner and Finance for Value Creation. Very interesting book. Both books are bestsellers. Not because I'm not saying because that I have authored them, but they are really good books. So with this, friends, it is exactly 5:59 in my watch, and I come to close of my session. Thank you so much to every one of you. Such a pleasure to have connected. There are a couple of questions that I can take as we have still 1 or 2 minutes left. So Rajora ji, अगर कोई किसी का सवाल है तो please do read it out and I will be happy to answer them. I can take 2 questions.
Sir, 1 second.